Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering the provisions of the bill that will extend disaster relief exclusions and deductions. We'll be covering this and other 2026 developments in greater detail at Spidell's Federal Tax Update webinar on December 17th and 18th. For a list of topics, go to spidell.com and click Webinars. The LaMalfa Disaster Tax Relief Act was passed by Congress and is now on the President's desk waiting for his signature. The act introduces significant changes to the treatment of personal casualty losses and wildfire-related compensation. Its provisions can be divided into two key sections: wildfire relief exclusions and the enhancement of disaster loss deductions. The Act creates new IRC Section 139 Cap M, which excludes qualified wildfire relief payments from an individual taxpayer's gross income. A qualified wildfire relief payment includes compensation for expenses and losses like additional living expenses and personal injury, lost wages, excluding those paid by the employer who would have otherwise paid them, and death or emotional distress. To qualify, the payment is required to be related to a federally declared disaster resulting from a forest or range fire declared after December 31st, 2014, and before January 1st, 2027. The exclusion applies only to the extent that the losses are not compensated for by insurance or other means. To prevent a double benefit, the Act specifies that taxpayers cannot claim a deduction or credit for any expenditure for which the exclusion is claimed, nor can they increase the basis of any property by the excluded amount. This provision applies to payments received in taxable years beginning after December 31st, 2025. The Act represents an extension of prior tax relief that was available to victims of wildfires through the Federal Disaster Tax Relief Act. The Act represents an extension of existing disaster loss deduction rules under IRC Section 163 by allowing a deduction for qualified net disaster losses plus the portion of other casualty losses that exceed 10% of AGI through the end of 2026. This provision also extends the removal of the 10% of AGI floor for qualified disaster losses through the end of 2026. Qualified net disaster losses are defined as the excess of qualified disaster-related personal casualty losses over personal casualty gains. The losses have to be attributable to a presidentially declared disaster with an incident period beginning on or after December 28, 2019, and before January 1, 2027. The Act also increases the per-event threshold for qualified disaster losses from $100 to $500, and it allows taxpayers who don't itemize their deductions to claim the qualified net disaster loss as an addition to their standard deduction. These provisions are effective for taxable years beginning after December 31st, 2024. Get news and new tax planning strategies with a subscription to Spidell's quarterly Federal Tax Update webinar. Sign up today for all 4 of our topic-driven webinars or just a single session at spidell.com under Webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.